Hello everyone, thank you for joining our Knight Frank UK Land and Property Tax webinar. I'm May Wong, Head of International Residential Sales based in Hong Kong, and I'll be your host today. We are delighted to be able to invite our guest speaker based in the UK, Mrs. Gladys Yao, FCCA, to go through the property taxes we should be aware of, especially when the UK government have been made some changes recently and how it would affect us. We will have time at the end for some questions, so please send them to me whilst you listen in. I'd like to give a quick introduction on Gladys. As mentioned, Gladys is based in the UK, a Singaporean expatriate, practicing since 2001, specialising in accountancy and tax services, with special focus on investors from Hong Kong, China, Singapore, Malaysia, Australia, and the US. Speaks Cantonese, Mandarin, and English. Gladys is also a general accounting practitioner and an authorised agent with Her Majesty's Revenue and Customs. She once mentioned to me that she tries to simplify rather than terrify homeowners when it comes to the UK tax system. So over to you, Gladys.
Thank you, May. Welcome everyone to my first seminar. 大家你好. When you're considering buying a property in the UK, the thing to do is to have knowledge, which is what I'm trying to do for you today. When you have bought a property, as some of you will know, and when you are preparing to buy a property, the first thing you will hear about is stamp duty. Then if you are planning to rent it out, the next thing you hear about is income tax. If you then decide to sell the property at a later date, there's something called capital gains tax. And then, of course, the dreaded thing that buyers look at is when you die, and if you still have that property, you have to pay UK inheritance tax. Then the very last thing I will talk about, but really will only interest people who hold properties in a company, is something called annual tax on enveloped dwellings. ATED for short, and you'll understand why I keep calling it ATED, because it's such a mouthful. Right, moving along, stamp duty is something that individuals pay when they buy a property. Now, this is not unfamiliar to you because you pay the same thing, but not the same amount in Singapore, Hong Kong, Malaysia, when you buy a property. It is based on the value of the property, and the purchaser pays it. Your lawyer who is doing the conveyancing will do the calculation for you, ranges from 0 to 12%. There could be some of you that buy more than one property at a time, and when that happens, there is something called a multiple purchase, multiple dwellings relief for linked transactions. Now, don't worry about it, because more often than not, the calculation will either benefit you or not make it more expensive. So you shouldn't worry about it. If you're buying more than 6 properties at the same time, i.e. same seller, same buyer, then you may be able to use something called the commercial rate for stamp duty. Now, a lot of you will know that from November 2015 onwards, there was a surcharge placed on stamp duty for a second property. This is 3% over and above the normal rates. So instead of 0%, your first band is 3%. Who pays this surcharge, you ask? Well, people that already own another property anywhere in the world. Now, if your husband owns a property, but not the wife, then it is still considered the wife's first property where you live. So it doesn't matter whether you're buying this second property to rent out or to use. You know, when your children go to study in the UK, you think you're going to buy a second property for them to use. Well, that will be caught under the second property surcharge. From April 2021, the Chancellor announced that there will be an additional 2% for non-resident buyers. You might ask, what is and who is the non-resident buyer? because of the COVID-19 situation, there have not been any more announcements to give us more meat on the bone or to give us more time to prepare. So therefore, is a non-resident buyer the same as a non-resident buyer now? Do you pay the 2% if you have already signed the contract but not completed? We have no answers to that. But the UK has a budget every spring and autumn, usually. So I suspect that we will know a little bit more when the autumn budget comes out. Now, stamp duty is also paid by companies. You split that into two parts. Companies that buy residential properties less than £500,000, same rate as the individuals. Although there is no first property, 0 to 12%, you pay the surcharge from property number one. Properties more than £500,000, there's a flat rate of 15%. Wow, you say, that is pretty high. However, if you are planning to rent it out on a commercial basis, i.e. not to the directors of the company, not to their husbands and wives and relatives, commercial rent, then you pay the normal rates. So same as individuals with the 3% surcharge. There is a link at the bottom of that slide. So for anyone who wants to calculate their own own stamp duty, just so you know and are prepared for what you might have to pay, then there's a link below that you can go to and try your hand at it. Right, after you've bought the property and you've decided to rent it out, most people ask me, well, what do I have to pay? How do you calculate the income tax? Well, you can deduct agent's expenses, any expense related to the rental income, so building service charge, any repairs and maintenance, that is all tax deductible, both for individuals and for companies. The next thing that people talk about is mortgage interest. It's a really complicated section, so I won't go too deeply into it, but just so you know, from 2017-2018 tax year onwards, mortgage interest is now not a direct deduction from rental income. However, if you remain within the UK's 20% tax band, which is £37,500 per person, you will not be affected by this restriction, because what they take away, they give back as a tax credit at 20%. Do companies do the same thing? No, companies actually get 100% deduction, direct deduction of mortgage interest. Some non-residents in the UK, some non-residents are given the same tax-free allowance as UK residents. Unfortunately, Hong Kong residents is not one of them, but Malaysians are. So what does this mean to you? It means you get an extra £12,500 per year tax-free allowance. So the first £12,500 that you make on your rental profits is not taxable. Non-UK companies, a lot of people in the past have set up non-UK companies, BVI companies, Hong Kong Limiteds, Malaysian Sendirian Berhads. Well, those companies used to be taxed at income tax rates of 20%. From April 2020, i.e. this tax year onwards, you will be brought into the UK corporation tax regime and taxed at 19%. However, for your 1% discount, what you will have to do is to file full accounts. So in the past, you file profit and loss account. Now you'll be filing balance sheet as well as profit and loss account, and perhaps notes to the accounts, full UK corporation tax filing. Right. Now, you want to sell in the future. There is something called capital gains tax. The annual exemption, i.e. the tax-free amount every year for non-residents, and resident selling, it's £12,300. Now, this is not specific to any country. Every person will get that. So if two people own a company, there will be 2 times £12,300 exempted from the calculation before you pay tax. The remainder that is taxed at 18%, and I forgot to say that there are no annual exemption for companies. So for companies selling, the first pound of profits you make is taxed at 20% up until April 2020, and then 19% thereafter. The remainder for individuals is taxed at 18 and 28%. However, you will also know that before April, if you bought the property before April 2015, the government had given you a chance to revalue your property to the value as at April 2015 and use that as the base cost for calculating capital gains. Now, those of you that have been in the market since that time will probably know that you've made most of your money, most of the profits are made from the time you bought it to April 2015, where the government came in and decided to dampen the market a little bit. So it is a good thing, if you're thinking of selling, to revalue your property as at April 2015. Something new that the government's brought in, we used to have to report the sale of the property within 30 days of the sale. They now want you also to estimate the amount of tax that you might have to pay and pay it within 30 days. So don't forget, that is a 30-day rule, and you will be charged penalties and interest if you don't do it. Right, the next slide, I'm having a problem moving it along, is income tax. Excuse me, May, I think I need help to move it. Great. Inheritance tax, sorry. Right, thank you. Inheritance tax is paid both by UK residents and non-UK residents. However, each person that owns the property have what we call a lifetime allowance of £325,000. Now, if you are transferring property between husband and wife, husband and husband, between spouses, the lifetime allowance is not used and it is free. The transfer between spouses are free on the death of one spouse. And if that is the case, the unused lifetime allowance is also transferred to the spouse. Therefore, for a couple in the UK, the tax-free allowance is £650,000 when both have died. Transfers to other than your spouse 7 years prior to the death is not subject to inheritance tax. The one exception to this rule of free transfer between spouses is if one spouse is non-domiciled UK and the other one is, then there is a restriction between transfers between spouses. It is not very common, so therefore I won't go into it in depth, but please do ask your UK advisors if one of you is non-domiciled. Right, the last slide before we go to Q&A is annual tax on enveloped dwellings, ATED, again for short. Now, these are only charged on companies that hold residential properties. So companies, residential properties, more than £500,000. The rates that you have to pay is annually, for the privilege of owning a property in the UK, is from £3,500 up to £236,250. You don't have to pay this tax if it is commercially let out. Again, you can't let it out to your directors, to your, so that is all not exempt from ATED. The properties have to be revalued every 5 years. The last valuation was April 2017, and the next valuation is April 2022. Now, I need to remind you that even if you bought a property April 12, 2012, and it was, say, £450,000, by now it might be more than £500,000, in which case you will fall into ATAD and have to report. This only applies to what they call non-natural persons, so companies, trusts, and some partnerships that have a company as one of its partners. And this applies to both UK companies as well as non-UK companies. Well, that's the end of me prattling along. May, over to you for any questions.
Thank you, Gladys. Great to see we already have questions, so keep them coming whilst we start our Q&A. So Gladys, shall we go for the first question?
Sure.
Mr. Fung has said, I've bought a property that just completed. When do I need to file my taxes?
Well, okay, the UK tax year starts from the 6th of April of any year to the 5th of April in the next year. So I'm going to assume that Mr. Fung, when he says just completed, have just completed in April 2020, in which case, are you ready now? You fall into the 2021 tax year. Therefore, you don't have to file income tax return till January 2022. So there is a lot of time for you to get used to the fact that you will have to file a tax return.
That's I'm sure Mr. Fung, you're happy to hear that. Not sure who the viewer is, but is the 2% surcharge applicable to company registered overseas buying residential properties in the UK?
This is where I am saying that there is not enough meat on the bone. They have not made enough announcements, but I'm going to say probably. Again, when I was talking about it, I said they didn't give us any guidance as to what non-resident means. So we still don't know, but I'm going to say there will be probably more announcements in October, in the autumn, but I'm probably going to stick my neck out and say, I think you will have to pay the 2%.
Okay, so we have to be aware.
Yeah.
And Mr. Lamb is saying, if buying using a UK company and involves 6 or more residential units from the same seller, is it true that only a flat rate of 5% stamp duty, i.e. the commercial rate, is applicable?
That is true whether it's a UK company or a non-UK company. So the commercial rates is not exactly straight 5%. It is straight 5% from, I think, £250,000 onwards. I'll have to double check that. But yes, given that you're buying 6 properties, I would say flat rate of 5% will more or less give you the amount of stamp duty you have to pay.
Okay. Another Mr. Lee, as a British citizen, is the tax different from an overseas buyer for buy to let? What I need to be aware of?
British, UK, okay. There are 2 different things here. You can be a British citizen, but non-resident in the UK. So, Mr. Lee, I would need to know where you live. But as a UK citizen, British citizen, you will get the annual tax-free allowance wherever you're living. But what else, May, was it the second part of the question was whether they have
to be aware of?
Not really. The only thing that you are not allowed to do is you won't be allowed to rebase your property to April 2015 unless you are a non-resident, although you are a British citizen. So that question has a lot of multiple layers to answer. So unless Mr. Lee comes back with whether he's a Hong Kong resident, that's all I can say for now.
Okay. Not sure if you can answer Mr. Sewell's question. Re-estate tax, what about transfers between spouses who are both non-dom?
Transfer between spouses who are both non-dom is absolutely, as I said, £325,000 per person, £650,000 for the couple when they die, but zero tax for transfers between two spouses.
Okay, so it may be this is an extension to Mr. Seal's question, because Mr. Max asking, what about if the apartment is held by joint tenant between the husband and wife? When one dies between the other, will the title be automatically transferred to the other? Maybe that's more of a legal question, but not sure from a tax angle.
Yeah, okay. So legally, tenants in common, you leave your estate as directed by your wills. Joint tenants, it goes automatically to the other person. But again, between husband and wife spouses, between spouses, when one dies and it is directed to the other person, then it is tax-free, inheritance tax-free. But if your will says that it goes to your children, then it is not inheritance tax-free. So if you are tenants in common, you have to make sure that your wills reflect where you want it to go as well.
Okay. Mr. Mo has, for properties bought before April 2015, we need to do a valuation. Is there any requirement on what valuation the UK government will accept?
We haven't had any test case, and if you read, what I normally say is you should ask for a valuation that stands up to scrutiny. So, i.e. from a real estate agent who's selling it for you, but who have backed up the valuation with what has happened in the area during that time. So a proper valuation. I wouldn't rely on a piece of paper that says it is valued at £500,000 as at April 2015. If it is challenged, you will have to stand by it.
Okay. Mr. Brunner would like to ask, what is the tax situation if you gift a property?
Very good question, Mr. Brunner. When you gift a property, you do not trigger stamp duty. So let's say you want to gift a property worth £500,000 to your daughter. The gift is valued at zero, so there's no stamp duty on it. However, if you bought that property and it was only worth, the cost was say £450,000 when you first bought it, then you will have to pay capital gains tax on the difference. This is where I say, if you're gifting it to a relative, then the best thing to do is to get a valuation, because one, it protects you when someone knocks on the door and say, well, did you pay capital gains tax? And you go, well, yes, I have, because I bought it at £400,000. It was valued at £450,000, and I gifted it to my daughter, so I paid tax on the £50,000. So that is the sort of thing you need to be aware of. No stamp duty, but there may be capital gains tax.
Okay. And Mr. Wong is asking, if I am an overseas investor in UK property, is the exchange loss deductible when capital gains tax is concerned?
No. I have not been asked this question for a few years now. The government assumes that, one, you are either buying or selling your own currency to buy property in sterling. When you sell, you also get your money back in sterling. The only tax you pay is in sterling. So unfortunately, no. Capital gain losses on foreign exchange is not tax deductible.
That's a shame, Gladys. Maybe from a friend of yours, a Singaporean, Stay is asking, are Singaporeans entitled to any tax allowance on rental income?
I'm going to have to say, unfortunately, fellow Singaporean, no. Based on the double taxation treaty between the two governments, Singaporeans are not entitled to the tax-free allowance. However, if you're Singaporean with a UK or EU at the moment passport, you are, but only if you have a UK or EU passport.
Okay, thank you. So Mr. Dunn is asking, if I hold a property jointly with other family members, I assume that I only report my share of the property for all taxes.
Yes, and I'm going to assume that your other family members will also be reporting their share of the income. Residential properties in the UK can have a maximum of 4 owners. So if it was shared between the 4 of you, each of you must become a registered taxpayer in the UK. So you have to, all 4 of you apply for non-resident landlord status. And once you have received that status, you will be entered into the UK tax system. But on the other hand, you will not have any tax withheld from you by the letting agent. So let's say there's 4 of you that own a property, but only 1 of you are registered as a non-resident landlord. They will still deduct for the other 3 their 20% withholding tax. So I would say if you own 4 properties, you have to report 4 separate income tax returns.
Thank you, guys. Mr. Mo is asking, do I still get tax benefit allowance if I remortgage my property?
That is
sorry,
actually...
Can I just finish on this one? He's saying currently full pay, but want to leverage a loan if there is tax benefits.
Okay, so yes and no. Under the UK rules, if your property was, say, £400,000 when you first bought it, and it has now gone up, so the amount of interest that you can deduct is restricted to the original cost of the property. So if it's now gone up to £800,000, the amount of interest that you can deduct is still £400,000. That is the restriction on remortgaging.
Okay, thank you. Mortgage loan interest cannot be directly deducted from the rental income. Your slide said 2020, 25%, and 2021, 0%. What does it mean?
Okay. So starting from 1718, they slowly reduced the amount of interest that you can directly deduct. So from 2017-18, it was 75%, then it became 50%, and last tax year it was 25%. In the current tax year, it's 0%. However, when it moved to 25%, the 75 that is not deducted directly is given back to you as a tax credit. So the calculation is a bit more complicated, but as long as the owner's net profit is not more than £37,500, the deduction given back at 20% is roughly exactly the same as if you had been given it as a direct deduction. It is a much more complicated computation. Then it's easier for me to do it on a webinar on this one-to-one basis. If I had a chalkboard, I would be able to explain it better.
Thank you, guys. Mr. Frank's asking, I bought a property a couple of years ago. The current value is lower than the purchase price. I wish to sell it to my son at market value. I presume I won't need to pay capital gains tax.
Yes, you're correct. You don't have to pay capital gains tax, but if you sell it to your son, instead of gifting it to your son, there will be stamp duty.
Okay. For mortgage interest deduction or tax credit, does it matter if the mortgage is taken out from a UK bank or a Hong Kong bank?
It doesn't matter where you've taken the money, where your lender is. In fact, no, it doesn't matter where the lender is. So it doesn't matter whether it's a UK bank or a Hong Kong bank.
Okay, thank you. Mr. James X, which name shall I use to buy properties in UK? My personal name as a Hong Kong resident, or a BVI company, or a UK company? The properties may be a long time holding and to be passed to my kids later.
And Mr.
James.
Okay, James. I would say there are very little differences tax-wise now between companies and individuals. Again, companies have certain advantages like the loan interest deduction at 100%, but now, whether you're a BVI company or a UK company, you need to report in the UK corporation tax regime, which is a lot more work involved. There also, with UK limited companies, the extraction of the profits is a little bit more complicated. So I would say if you really intend to buy and pass on to your children, there is no reason not to look at either a Hong Kong limited company or just buying it in your individual names. Because they have now also put a inheritance tax on the transfer of shares in a limited company that is holding a residential property. So you do not escape inheritance tax by buying it in a limited company, which is what people used to do in the past.
Thank you, guys. Maybe an extension to that question. Is there much difference on tax if the company is set up in the UK or is it set up in Hong Kong?
There is no difference in tax. The only difference is, as I said, the extraction of the profits. In the UK, there is a dividend tax when dividends are extracted, profits are extracted as dividends. There is no such thing for a BVI company, and I'm going to have to defer on whether this is the same for Hong Kong Limiteds and Singapore Limiteds. You will have to ask your accountants in those regimes. But in the UK, when you extract profits as dividends, there is a dividend tax.
Okay, I think you've probably answered this next question before, but Mr. Chan, more for himself. I'm a UK citizen, but I left UK and live in Hong Kong for the last 15 years. I own a property more than 22 years, which lived there for 6 years, and the rest of the 16 years I rented out. I would like to know, what is the profit gain be calculated? And Mr. Chan's living in Hong Kong. Okay,
Mr. Chan, that is probably one of the most difficult questions to answer without a piece of paper and a chalkboard. Suffice to say, because you have lived in the property before, you may be allowed to claim private property relief, which will give you the 6 years that you lived in it will be tax-free, and the rest of it will be subject to capital gains tax. As a non-resident, you will also be allowed to rebase that property till the April 2015 value. So you will probably have to pay some capital gains tax, but the calculation on that will be a lot more convoluted and complicated.
Okay. And Miss Ng is asking, can you elaborate again on the personal allowance? You mean if the property is bought by a Hong Kong ID holder, then he cannot claim the personal allowance of the £12,500?
That is correct. The double taxation agreement between the UK and certain countries give the residents of those countries the right to claim a tax-free allowance. So and the list changes from year to year. So at the moment, Malaysians, Australians, Canadians, the list is quite long, Taiwan, they are all allowed the £12,500 tax-free allowance. Unfortunately, Hong Kong residents are not, unless you are a UK passport holder living in Hong Kong. Then you are entitled to the tax-free allowance.
Okay. Can Singapore tax residents, Malaysian citizens, to avail to tax credit on mortgage interest?
Tax credit on mortgage interest, yes, because that is available to everyone. But was it a Malaysian living in Singapore?
A Malaysian citizen.
Yes, okay. So a Malaysian citizen living
resident.
Okay, so a Malaysian citizen living in Singapore will get the same mortgage interest deduction, i.e., or tax credit, the same as anyone else. What you don't get will be the annual tax-free allowance. The rules say that you have to be a Malaysian citizen paying tax in Malaysia. So if you do pay some tax in Malaysia, then you will qualify.
I'm not sure if it's from the same viewer, but how about transfer taxes between spouses due to a divorce?
You will come up with more difficult questions, May. It will still count as a transfer between spouses, but again, the divorce rules are a lot more complicated again. But I'm going to assume that this is your investment property, and that you are, say, Hong Kong, Singapore residents, whatever. So you are both non-residents, and therefore you have never lived in the property. And so transfer between spouses, whether on divorce or on death, will still be free of any tax.
Okay. Mr. Lee, I have a property under a BVI company with 4 shareholders. If the company sells the property, the company is liable to corporation tax, but shareholders need not pay any tax?
That is correct, Mr. Lee. The company pays the tax, and therefore it will be at 20%, 19% if you sell it now or in the future. And if corporation tax rate falls, that is also what you pay. But the company pays. The company does not get any exemption from capital gains. So if you had 4 shareholders, each of the shareholder, if they individually held the property, would have a £12,300 exemption, and that is 12,300 times 4, 50-some thousand pounds exemption for the same property, but not if you were holding it in a company. There is no exemption for companies.
Okay. Mr. Dare is asking, I bought a UK property on October 2019 when I received the tax notice from UK government, or any website I can file in the tax. When is the cutoff date from tax filing?
Okay, October 2019 is when you bought the property and when you went into the UK tax regime or registered with the UK tax regime. And that means you bought the property in the tax year 2019-2020, in which case you need to file an income tax return by January 2021. Yes, by January 2021. You can register online for a government gateway in order to file your own tax. I've encouraged clients to do that, but if you find that a little bit more difficult, then I suggest that you engage a UK accountant or someone who is a registered UK tax filer.
Thank you. Difficult question for Mr. Chu. For joint tenants between parents and children, if one passed away, would it also or would it be also exempted from inheritance tax?
No. Under joint tenancy, it means that your share automatically goes to the child. There is no free transfer between parent and child unless the transfer or your share of the property is less than £325,000. So if your property is worth £650,000 at the time of your death, your share is £325,000. It goes to your child, who is the other tenant. Then the transfer is free, but any amount over that, so any value over that, will be taxed at 40%. May, under inheritance tax, if I can just add, for most people, I suggest for your UK assets to very clearly state in a will who the asset goes to, because if you don't, it could go to, say, your joint tenant. If it is a child, then taxes is immediately triggered. So if in the will you direct that your share doesn't go to the other owner, but goes to your wife, then no tax is triggered at that point. So it is quite important to have a will just for your UK assets.
Very good advice, Gladys. And Miss Chow is asking, for reporting and payment of capital gains tax from sale of property, it is now 30 days for properties under personal names. How about properties under BVI company? Is it payable as corporate tax with 1 day accounting period, which means that CGT needs to be paid immediately?
Yes, is the answer to that. Although the HMRC is a little bit, I would say, not totally prepared for the transfer from income tax, which is what corporations were, BVI companies were paying tax on, to corporation tax, which is what they will now have to pay tax on. And then they added this capital gains tax to be paid within 30 days on top of that. So yes, it has to be done. I am advising everyone to make sure that you report within the 30 days. However, when you do report it, there is a time lag between the reporting and receiving acknowledgement and then receiving a tax paying reference from HMRC. That will be ironed out, but to be very, very clear, you need to report within the 30 days, and that if they don't get back to you within 30 days, it takes the burden away from you for non-compliance of paying within the 30 days. So reporting is much more important, and paying, well, it'll give them time to iron out the what they need to iron out. But we need to report and then be ready to pay it within the 30 days.
Okay. Gladys, we're having to go to our final question. So to finish off, what is your best advice that viewers should be considering to do or action in today's current situation?
COVID-19's thrown quite a spanner in the works. The UK government has actually stopped any eviction notices from being sent. So if you are a landlord and your tenants tell you they're in trouble, so number one, the UK government is helping employees in companies if they were told to go on leave because there's no work and because of the lockdown. The government's paying 80% of their salary, capped at £2,500. So what I can say to landlords is, if you are asked for for some sort of rent forgiveness, whatever, ask for evidence of one, that they have either been retrenched, or two, they've been put on leave but are getting 80% of their salary. So if you if you know what their situation is, it will be easier for you to make a decision as to how you can help your tenant. To help landlords, the UK government have asked all the banks to give homeowners a 3-month holiday on their mortgage payments. However, if you speak to your mortgage brokers, and I know Oriel Finance has done one of those webinars, the mortgage interest is not forgiven. It is just added on to your final payment. And I would suggest that you work out what it costs you to maintain the home and work out an arrangement with your tenant and help each other through this crisis.
Brilliant advice. Thank you, Gladys. Well, time's up for us to finish. If we haven't been able to answer all your questions today, we will be in contact, or do email us. But before we go, Gladys has very kindly offered to provide a free half-an-hour one-to-one consultation call to our Knight Frank viewers. Limited spaces, so make sure you like our Facebook page and contact us to book your appointment. Also, if you are searching for a home or looking for a property investment, our Knight Frank sales team is available to discuss the options with you. So do email us on irs@hk.knightfrank.com to book your appointment with Gladys or discuss your property needs with our Knight Frank team. Thank you once again, Gladys, for your time today. Appreciate that it's an early start to your day. I need to thank you, our viewers, for tuning in. Don't forget to subscribe to our Facebook. Stay tuned and look forward to seeing you at our next webinar. Bye-bye.
Thank you, May. Bye-bye.